Ladies and gentlemen, it is now time for the next panel discussion on mobilizing capital for climate finance. I now invite the moderator for the panel discussion, Shri Vivek Adya, Associate Director BCG, to the dais. I take this opportunity to invite the panel of speakers, Mr. Anand Vishwanathan, Head Enterprise and Model Risk and Market and Liquidity Risk, Axis Bank Limited, Ms. Rupa Satish, Country Head Sustainable Banking, IndusInd Bank, Mr. Niranjan Banodkar, CFO, Yes Bank, Mr. B.S. Venkatesha, DMD, NAPFID, Ms. Neha Kumar, Head South Asia Program, Climate Boards Initiative. Okay, so I request Sri Vivek Adya to kindly proceed with the discussion. Over to you, sir.
Thank you so much. And I think after a very enthralling session with the regulator, I think this is where we'll try and discuss more about mobilizing climate finance. You know, ever since I've been working in this space, I've been hearing and actually observing that climate change is driving the biggest capital reallocation in history. And you can see it here. I have the largest panel of the day for now, and this is where the interest comes in from mobilizing climate finance. I think we've got stalwarts from the industry here who've been amongst the early movers, first movers. So we'll try and learn some of the best practices, you know, what has happened, what's the forward-looking outlook as we go towards tapping the new piece of capital, if I can call, that's awaiting to be tapped. Maybe if we can try and, you know, have some quick interactions so that we can catch up on time a little bit. Mr. Venkatesha, if I can start with you, you know, let's do the basics. What are the different sources of green financing that are available? You know, how do you tap into it? And as a DFI, what have you looked at?
Yeah, thank you, Vivek. So if you look at, Mr. Nair already mentioned the type of the finance or the amount of finance which India needs to meet its declared goals for 2070, starting from 2030. So it's almost 170 billion per annum. So which is a requirement of almost 2.5 to 4 trillion US dollars by the time we reach our goals in 2070. So for that, the current inflow is only 50 billion US dollars. So that is almost 3.5 times of the current inflow which is required for the country. So even the amount around 50 billion which we look at, what exactly is happening in this space. So it is mostly some of the top rated clients who are able to get access directly from the international market. They are able to get the finance. But some of the other institutions and the people who are not in compliance with these norms required for attracting the finance, they are really deprived of the capital available. So in order to establish that kind of relationship with the global investors, so there is a strong strategy which the banks have to adopt. So according to me, the green financing or green should not be a compliance at the operational level or at the bank's level. It is a clear strategy for mobilizing resources. When you take it as a strategy, yes, everything will fall in place. So definitely you need to have a two set of verticals within the bank. So one is the normal commercial bank which keeps doing its activities. Definitely we cannot do away with the lending to thermal sector or non-green sector. So that is part of our activity which commercial banks and the DFIs have to do it. So that is looking at the country's priority. But when it comes to the green, definitely you need to have a parallel vertical which completely focuses on creating that kind of pipeline and that kind of principles which the investors are looking at. So you need to have a clear guidelines, irrespective of whether you have taxonomy or not. You need to build your own policy and frameworks and strictly implement those aspects so that you are able to make it attractive for the investors and also easy for you to sell as a portfolio level or at a project level. You can definitely invite because multilateral banks are starved of that pipelines. So when they look at these kind of features available at the bank level, so some of the early movers are there in the banking sector. They are doing it. So as Mr. Nair also said, it is not an overnight activity. It needs a strategy. You need to start working on this because accepting the policy at the business level is not that easy. So if there is a strategy department which talks about ESG, which I want to implement, but at the business it's a big stumbling block because it has to go through several scrutiny of activities, and if the categorization comes at a high risk category in terms of climate risk, then whether it is a go or no go situation. So whether your policy makes the balancing act to take care of these things, these are very important decisions. The tone from the top is very essential. And if you take it as a strategy, yes, once you have your policies in place and good monitoring mechanism, so it is based on the trust and the confidence which the investors have on your bank policies. So then all your climate bond, blended finance, everything will fall in place. So there are multiple instruments available which institutions can do it. But basic thing is, as a strategy, you need to look at seriously as a good resource mobilization. If that is done, that is definitely it is feasible. That's what me.
Perfect. No, I think, and picking up on that, Rupa, if I come to you, you've seen amongst the most successful green deposit issuances and stuff. Venkatesha was talking about strategy, so my question to you is, what does it take, right? There are different pieces that need to be fixed together internally within the organization, outside in the ecosystem. There are so many things that you need to tackle. So what does it really take?
Hello, yeah. What does it take? Yeah, so I'm sure I'll just share how we have gone about doing it. I think this is a very challenging space because typically banks want to shy away from lending long-term project, large, bulky sort of assets. And a large part of this climate finance and green finance fits into that bucket. So that is the first challenge that we have. Second challenge is ALCO. The kind of funding that banks have and the kind of tenor that these assets typically ask for, there is a misalignment there. Third thing is the trickle-down effect from large cap, SME, MSME, etc. The kind of expertise that is needed to assess and underwrite these things. You can only build such teams for large caps and some sizable exposures. You cannot put all this expertise in SME lending and MSME lending, where the need might also be there, very, very strong need, but the bank cannot really structure itself along those kind of things. So you need to have some ready-made products, which is green sort of products, parameterized, which can be provided. So multiple solutions we have adopted. Firstly, what we have tried to do is we've underwritten close to 5 gigawatt over the last few years now. It's a cumulative kind of an amount, so 25,000 odd crores. But we have been able to syndicate it and sell it down because we're a mid-sized bank, we don't have the ability to sit on this kind of a portfolio in our book. So there is a lot of sell down and syndication linked with the underwriting itself that we have been able to successfully do. Close to 15,000 crores have been raised through a sell down itself. Then secondly, partnerships with DFIs and multilateral agencies. So we have forged two kinds of partnerships. One is risk sharing, which is pari passu risk. Basically, they do an assessment on the bank's underwriting capability, and then they say that, okay, if you're taking 50 crores, I will also take 50 crores. So you know that you can go and your teams can go and underwrite and boldly pitch for a 100 crore loan. You know that on your balance sheet, you're only taking a 50 crore exposure. Third thing that we have done is, same thing with DFIs, but their processes are very slow. Banks are also slow, they are slower. So what you have to do is try and bridge that a little bit. So that again is sort of a underwriting and sort of sell down only, but you're not going to a wide market and you're tailoring your term sheet in line more with DFI requirements, because they have quite increased requirements for assessment and all of that. So you build all that in, but you give them the time to process that loan. So these are 2-3 strategies that we've adopted, and of course these are institutional access to institutional funding. Apart from that, we have raised these green bonds. We were lucky, I would say, got in a little early. And fortunately, we were able to see a great amount of retail. I opened it up both to corporate and retail. Corporate, actually, we gave 5 basis points lower than our card rate. Retail, we gave the same card rate, but we asked for longer tenor because of that asset mismatch that we wanted to plug. So ALCO, we did an exercise and we found out where is our gap coming, liquidity gap coming in ALCO. And that's how we could convince internally, let's offer a green deposit for that tenor. So we just carved out that tenor and we said in this tenor, because you can't as per RBI offer differential interest rates. So what we did was we chose a tenor and we put that tenor as a green tenor. And monies we welcomed into that tenor, and as a carrot to the retail investor, we said we'll give you a green certificate, we will give you a green badge. Everybody, going green is fashionable. So you can put it on your LinkedIn post or Facebook post, issue a certificate, all that kind of thing. We also got it assured by a third party. So these were some of the hacks, I would say.
So I think thanks for sharing the hacks and very, very useful. Niranjan, if I come to you, you've done like 3 rounds, I guess, on green bonds and you've done many other things. How do you see FIs have evolved over a period of time and the ecosystem changes that you've seen, from the time you first did it to what is happening now?
No, thank you. Good afternoon, everybody, and thanks for having on this esteemed panel as well. In fact, I'm not sure if there will be too much of value addition after we've heard Mr. Nair speak about this subject already, and with the other bunch of esteemed panelists here. But just on the specific journey that Yes Bank has had, to be honest, when we started focusing on ESG as a subject and climate being an important component of it, to be honest, our ethos was a little bit more saying, can we focus on new age economies, right? And that was a segment that we thought, because clearly small bank, cost of funding disadvantage. So we said, okay, where do we think is the opportunity? And new age economies, renewable kind of fit into that space quite well. So the way we approached it was to say, look, let's build expertise here. It's a new area. And then see if we can build scale. And once we build scale and had a bit of a confidence come through, our ability to then also attract financing, because there was a proven assertion in that particular segment, also played out over a period of time, right? So in fact, at a point in time, IFC's largest emerging markets exposure was to Yes Bank. But that was on the back of what we had already done on the financing side, right? Over time, what we've seen is clearly the expectations that a lot of these multilateral institutions had was, we spoke about taxonomy, what you're doing, the definitions. So I think there was a lot of nitpicking on, what kind of assets you want to lend to. But it was not just where the money was going, but the frameworks and the policies that you had to adopt, right? And then at that point in time, which was maybe around the 2012, 13, 14 type, the question that was back at us was, do we want to adopt these? Because then it's a very strategic call that you are taking, for manifestation of business and credit. And ultimately at that point in time, we said that we will adopt with a certain plan, staggered plan, to say, okay, if I'm 100% compliant, maybe by 2018, but I could start building the compliance over the next 5 years. And in hindsight, I think it was a good decision. But the point I wanted to drive was, it was more new age economy thinking, thought process, build knowledge, expertise in those segments, while perceived to be commercially unviable at that point in time by a large part of the sector. Because you spend time, you could make it work and then attract financing into that sector. Of course, we've also seen the regulations change over time that now allow green deposits. We've seen many banks come out with green deposit programs. We did our bit as well in 2016. SEBI came out with the green bond guidelines. We came out with that as well. But I think fundamentally, I would say the way the ethos has changed is, do we believe climate and ESG is something that we have to do because regulators are asking, or let's say because maybe stakeholders around the world are asking more questions? Or do we believe that there is a real risk and at the same time a real opportunity for banks to play out, right? If the answer to that is yes, a lot of what then finally flows into the bank, the way you operate, is just manifestation of that thought process, right? I mean, at least I'm glad to say, I know we'll need a lot of helping hand from the regulator, from the government, but the climate and ESG is a very strong pillar of our strategy. So much so that every credit decision goes through the lens of climate and ESG evaluation, environment evaluation, social evaluation. There are, from a computation standpoint, we've already looked at electricity sector from financial emissions computation. I think to the point that Mr. Nair also alluded to, we are now extrapolating that to other sectors which are high carbon emitting. So there is that intent which comes from the top, and there is delivery which is working at a pace, right? Just to conclude, while we may have done our bit of let's say the DFIs, we might have some green deposits. I think the fact remains that it is nowhere close to what the real requirement is. I think the opportunity set and the need is actually quite large. And I think that is where collectively it is not just individual banks or a group of banks that will be able to do this. I think it is as a nation, as a regulator, I think we all have to get working towards this. And there are a lot of things that we could work towards. And I think we've seen a great momentum pick up post the pandemic. Whether it's the government, whether it's the regulator, and I think we should just, take advantage of the momentum. Thank you.
Lovely. I think picking up 2 or 3 points from what you mentioned, Niranjan. One is, the courage to think about new economy, new age solutions when nobody is doing it, and long back. Also driven by conviction about what's right, and then the need, which you concluded. I'll park the need and the opportunity question for later. But Anand, if I come to you, you also wear this risk hat, and like Niranjan was mentioning, new economy, new solutions come with different type of risks and new kind of exposures. What has been the Axis journey in this space, and how do you look at things?
Thanks Vivek, and thanks for calling me over to this forum. So at Axis, just like as Niranjan mentioned, at yes, ESG and climate risk is quite seeped in from the top. So we have an ESG committee of the board. So the thought process is clear that climate risk and ESG risk need to be integrated into sanctioning processes, and that's what's done. So that takes care of the fact that you have a climate risk and ESG lens. The second angle, and that flows into our financing also, is that we want to do good. Therefore, we have taken public commitments. So we committed around 30,000 crores of E&S financing over a 4-5 year horizon. The intent is that we want to lend to assets which make an impact on society in a positive way. But while doing so, and this is an important thing that is clear to all of us in the sanctioning committees, in the bank, it cannot be at considerations which are not in line with credit and commercial requirements. And that, the reason being that, if you just go back last 6 months speeches by the governor, very clear articulation, the responsibility of the board is to protect the interests of depositors. And the interest of depositors is not in wearing a venture capital hat, but in wearing a banker hat. So if a green, let's say a solar power plant comes up for financing, the fact that there is an NTPC or a SECI behind it to secure its receivables gives me the comfort to do good. Would I, as a banker, venture into, let's say, green hydrogen enterprise? Answer is possibly no, because as a banker, I'm a custodian of public money, and that's where what Mr. Nair mentioned, what's been mentioned earlier today also, the concept of blended finance and alternative finance sources becomes important. Now, as a banker, we have explored, this entire world of alternate blended finance, and we have got this thing in the public space with Garantco, and we've got some transactions underway there, wherein there is a co-guarantee. So the core risk in any green, and which Rupa also rightly mentioned, is around asset liability mismatch, and then there is construction risk and technology risk. And what we saw during the pandemic was that if the policymakers of the country decide to fix a problem, look at the entire ECLGS scheme, It was a 20% credit support from the government, sovereign support. And I think it has been a blockbuster. Bankers used it to support entities that needed to bounce back from the pandemic, and the government has not seen much losses on it. If the similar thought process could be extended to the climate world, and where we look at policy, the ministries, the government providing credit support under some means, whether it's a subsidy or whether it is support to the bankers or it's an interest subvention, whatever it is, then these blended finance alternatives become all the more palatable to the bank. And we as a banker also, you'll be aware, we have raised sustainability bonds. So our experience has been that there is uptake. The investors are willing to come in and put money in if we are able to demonstrate end use. But we need more support for bridging the gap of credit quality, and it is making commercial sense. And that's where we would look to the government. I hope that addresses the question you had asked. Thanks.
Super. No, I think that does. And Neha, you know, I had parked the question about the opportunity, the need and everything, right? We've heard about different options. We've heard about the hacks. We've heard about, you know, the different approaches to do this. Maybe I had 2 or 3 questions for you, Neha, and maybe you could just answer them in one go. You know, what's the need? What's the opportunity? Where is the market that we've not even seen? You know, we heard about blended finance, and suddenly it's unlocking way bigger capital than we would have expected, you know, with that approach. And then to tap onto that market and make the most of it, capture a bigger share, what is it that people need to do on taxonomies and systems and, you know, all of it?
Sure, thank you. So I think to begin with, I will say that we have entered the era which one can say 2.0. Sustainable finance 1.0 is over, and we have to get into action and rapid action. And there's a lot of things happening, but they're happening in pockets. So ultimately what we have to do is to put a comprehensive strategy together, and I think the mantle for that will have to be borne by the government as well as the regulators. That said, market, both in terms of financial sector as well as the corporates, have really picked up on the opportunity. Now, if you look at the global opportunity, I'm talking about mobilization of thematic finance, then it is nearly $4 trillion globally outstanding at the current moment and growing, which is from a couple of billions 10 years ago. And if you look at India, then it is at $33 billion, you know, by the mid of last year. Now that is decent, but not optimal. You know, China is issuing green bonds nearly 15 to 20 times that of India. In relation to the size of economy and the financing gap that we have to bridge, I think we can really, you know, play optimally to the opportunity that exists. Now, just to break these numbers in terms of what we have seen and where we have seen the opportunities, avenues of growth, if you take financial sector and if you take corporate sector, when we began issuing green bonds, which was in 2015, the initial couple of years were pretty interesting. The financial sector, the banks, and the corporate sector were running neck to neck. Then the financial sector started dipping and corporate sector started to pick up. And in 2021, $6 billion were issued by corporate sector and only $1.1 billion was issued by the financial sector, which included NBFCs and not only banks. Now, there are many reasons for that, but I think that in the last 3 years, the pace that has been set is remarkable. And why I mentioned last 3 years is for a couple of reasons. RBI, today you heard Mr. Nair actually comprehensively telling you what needs to be done. 3 years ago, that was not the case. They were very skeptical about the whole debate, right? So, and Ministry of Finance itself. And I think these are important milestones. And the point that was being made since morning, whether that was taxonomy, whether that was transition plans, whether that is blended finance, all of that requires some sort of a comprehensive strategy right now. Pre-G20 era is also something, and post-G20 priorities are something to be looked at. Now, let me just come to the to taxonomy and why and where it is, because I was part of the taxonomy development working group, which was set up by the Ministry of Finance, and this is a room in which we can discuss these things. That a substantial part of the work has been done. We have the Ministry of Finance, actually we had very limited time. We have looked at mitigation in 2 sectors, providing definitions, which also, by the way, includes certain social aspects, SDGs, and we have templatized it in such a manner that it becomes easy for, we call that as a shopping list of the future. So it becomes easy for financial sector, it becomes easy for the corporates, the real economy actors, and some templatization is required. Otherwise, that's where I feel that the bankers are most happy with, that you have something which makes the technical job pretty easy to just mark, right? That is a tool which is not available right now in the market, okay? So we covered energy, we covered transport from the mitigation point of view, and we covered agriculture from the resilience point of view. And the idea was that the transition sectors and transition activities will be defined in the phase coming up. Now we have to see, and I think having really engaged in global conversations during G20 year, this year should be a very important year for the Ministry of Finance, and we hope that will, some action will take place on that front. When taxonomy, why it is important and why it also is linked to transition plans. So taxonomy, like Rupa said, and in the morning, I think Smita also mentioned, that is the tool which will help you tag your loan book, tag your assets. Without that, you are just, sort of going all over the place. So when we talk about refinancing, when we talk about recapitalization, if you do not have that help, you will probably not, you will again be batting under your, potential that you can. The other thing that I just wanted to conclude by saying is that, the avenues of growth, right? Storage, EVs, even resilient agriculture, these are places where there is, with some effort, there are possibilities and the potentials actually of green bonds there. The other point is the cost of capital of raising finance, and I think here the sovereign bond issuance is a very, very important development. Local currency, exposure to foreign investors. Again, what we have done for sovereign bond, the regulatory support that we extended to sovereign bond issuance, can that be extended to corporate debt issuers, right? That is important. So PFRDA or RDAI right now says that, the insurers can invest in sovereign green bonds. Can that be extended to the corporate debt market? Basically, what we need is to create demand through local green capital pools, which will either come through mandate or come through incentives. So these are the kind of discussions that you will have to have. The last point, if you have the time, otherwise I will bring it up later.
Maybe let's park it and come back. But Neha, very important pieces about big opportunity and big need, but also having focus on taxonomy and then using it to match the borrower, lender kind of a space. I think that's really nice. Venkatesha, if I come to you, building up from the strategy piece that you were talking about, and then to Neha's point about how are you operationalizing the taxonomy and how are you putting it into practice to raise, or build a roadmap towards raising green finance and then planning towards it? Maybe some quick thoughts there.
Thank you, Vivek. So at NAFID, being a new institution, we are well positioned to start with the right frameworks in place. So as a part of that, yes, we are just framing our ESG policy. So where we are engaging with the consultants who really look at the need is not the domestic requirement, it is mainly to meet the international requirements, because we are seriously looking at building the right portfolio and channelizing the green finance for the country. As a part of that, yes, we are quite engaged with most of the institutions, including the Climate Bond Initiative, where we are working closely with Neha's team. So where we would like to build some of the best structures which we can do for blended finance. So as a DFI, how we can position. Taking the clue from the G20 recommendations, where one of the recommendations is the institutions like GCF are recommending that they should engage more with the DFIs because they are more responsible and more connected with the local players. So that is where the responsibility lies on NAFID to build such portfolios and develop the green pipeline. So as a one step ahead, we are trying to build, take the projects which are in the green, in the national infrastructure pipeline and build some at least top 15, 20 projects, even not only for the bigger projects, even at the smaller levels, at the urban infra level, where the municipal corporations who are looking for some good green projects. So we'd like to make some around 50 to 60 bankable projects. So if the pipeline is there, money flows in. So that is what we are looking at. And on the product side, yes, we are looking at partial credit enhancement is one of the such projects which are very essential for making a kind of risk sharing for the green finance, which is a part of blended finance structure. Again, we are looking at the local level. So we are trying to build that as a part of the product innovation which we are doing, trying to do it. So there are few regulatory dispensations which are required. We are discussing with the Reserve Bank of India. Once they come through, probably we'll be able to launch that product quickly. So apart from that, the capacity building is very essential. So at the institution level, so with just having the framework doesn't help us. We need to have a right set of people who do not become an obstacle. This framework should not become an obstacle. It should work like a balancing act where there should be an exit route also for the projects which are not going through this one. But at the same time, they should have a strong conviction to give recommendations to the customers who can adopt those things and make them bankable again. So that is where we are working towards those lines. So probably next 2 to 3 months, definitely we'll be well positioned to take up these assignments. Yeah.
Perfect. No, I think, and picking up on that, and Anand, if I can bring you in, framework should not become an obstacle, but you still need different systems, processes, capabilities, whole lot of things in-house. When it comes to green, it's quite complicated, right? So when you invest into EVs, does the vehicle cost tag as green versus only the battery? Does the charging infra come in versus the entire transmission system? How are you looking at things when you are building internal, systems and capabilities to the point of framework being an enabler?
So, see, data is clearly the challenge because the kind of granularity or complexity of data is not necessarily available in legacy systems or even in new systems that are being built up. So let's take EV for example. If I create a product code and a segment code in my core banking system, that solves part of the problem. But there will be issues around borrowers who have multiple lines of business. So we are trying to get account level tagging, but it's not that easy because you will need to tag accounts and create data not only for the good but also for the ugly. So you will need transition risk or physical risk to be also tagged at an account level or collateral level. This kind of exercise will take a lot of time, a lot of effort, and may actually not be worth it right now. But we got to start somewhere, and I think what Mr. Nair pointed out was extremely sharp, that you start investing today in the data, the analysis can come in after 3-4 years. So that's one area we are struggling with as bankers. At Axis, because of the fact that we've got these issuances out, we have got a system which we have put into our core banking now, in which we are tagging assets as green. We tag outside the system. We are able to identify the the browns and the high transition risk assets or high physical risk assets. But that's something we need to slowly fix over time. To specifically look at the question that you're answering, am I going to be able to fragment my collateral or fragment the assets? Today, no. Tomorrow also maybe not, but certainly we'll have to start investing in that thing today. Yeah, so that's an important area. One just passing thing I would want to leave is that if you look at the world of climate finance, so there are two aspects of its impact and end use. Either which way, you will need to invest in data. End use is of course an easier thing to do because you don't need to spend money and measure outcomes. But even to just track an asset as green or not green is an end use issue, and that needs to be tracked. You need to invest in that infra for it. Yeah. That's it. Have I addressed your question?
Thanks again. And Rupa, if I bring you in, right, end use and tracking the assets and stuff brings me to a classic conundrum, the question that people have: should we create a pipeline first or should we raise resources first? What comes?
For banks, access to resources is not really a very big challenge. I would say. But the thing is, all through the day we have heard of the scale of opportunity that lies ahead. So if everybody, Axis Bank, Yes Bank, IndusInd Bank, we adopt the same strategy, where will there be a differentiation, right? So at the end of the day, the winner will be a person with a differentiated USP. How does that USP get developed? I feel in this space, a slight 50 basis points cost advantage will give that USP. One is we can keep looking at Reserve Bank of India saying, reduce my cost of reserves, adjust in RWA, but that is a banking-wide thing that will happen. So again, there is no differentiation in that. So I feel banks who would be in a position to develop some innovative product again, the shell, it gets copied by others within 6 months to 1 year, because money is very fungible. At the end of the day, loan, you can, like even Mr. Nair said, you're packaging it, putting some, bells and whistles and packaging a loan at the end of the day. So I feel, in other parts of in the world, I have seen very interesting structures by which they combine, many of us have alluded to this blended finance and platforms like this. Now, if a bank is able to, and it's a very challenging task, because to get 2-3 players with different risk appetite, with different capabilities and strength, with different organizational objectives, but everybody aligned on sustainability and green. If they come together as a partnership, and one person will have a higher risk appetite, one person will have a grant funding capability, and then we should be able to create a platform which it's like a scalable platform, a large platform, which can then go ahead and provide loans. I think that would be a game changer. A bank or a financial institution, even NAPFED, because they have the government's muscle behind it, any bank or financial institution which is able to do that, because every borrower today is saying, why should I do so many regulations and compliance and end-use tagging, and for what? Are you going to give me a 50 basis points reduction? What are the banks saying? Why should I give? Is the risk better? Mr. Nair said the risk is not very clear whether the risk is better. Then is my cost of capital different? If it's the same, then how will there be a differentiation? So I feel it's very important to develop that competitive, advantage for some FI. If I crack it, I'll be the winner. So I've been desperately trying to work on it for the last 18 months, but it's tough because everybody works in silos. We're talking about large multinationals, large banks, large foundations. It's easy to say it, but when you put a term sheet in the front, everybody has different languages and different expectations. So it's WIP.
WIP it is, but Niranjan, you also wear a CFO hat, and you've seen this from different stakeholder point of view, right? Reporting back to your credit line extenders, stakeholders, shareholders, everybody, even the regulator per se. What's your kind of guru mantra, if I can say, to manage all of these different complex pieces out there?
Look, if you look at the different stakeholders, thankfully, I don't think there is a significant misalignment of thought process, right? Maybe you could say different stakeholders could be at a different stage of evolution in this space. But I think broadly everybody is on the same path, right? So let's look at, we are listed banks now. One can argue whether we have to take care of our shareholders more than our depositors or vice versa, but there is a linkage, right? So shareholders, you look at domestic financial institutions, you look at foreign financial institutions. there are specific arms of stewardship sitting in these investor segments who are today in many pockets actually overruling the decisions that portfolio managers are taking, right? And I have had conversations, especially also given some of the peculiarity of our own journey, where I have had conversations with the head of the stewardship arm, and only after his or her go ahead is when, let's say, the investment may have happened, or let's say they decided to hold on to that stock, right? So clear influence, both domestics as well as international. You look at rating agencies. We are finding, so of course there's the whole new ESG rating philosophy that's playing out, but even for the classical credit rating agencies, if you actually just go through, let's say, Moody's rating page, they are now within the credit rating carving out what is your ESG score. So clearly, there is, if you have good disclosures, if you have good governance, if you have a climate strategy, all of that ultimately is getting baked into your ratings, and therefore has an implication in the way you look at deposit mobilization, borrowings, and the cost of it, right? We look at borrowers. I think borrower journey, again, two different pockets. Ultimately, segments which are green, inherently green, clearly where it is evolved, and let's say evolving. Where it is evolved, renewable today is evolved, everybody is lending, no problem, everything was fine. But there are segments which are evolving, and that is where, like Rupa also mentioned, I think there will have to be a public-private partnership or a better understanding of those segments for banks to kind of stick their neck out and say that, look, I understand this space, I'm happy to bet on this space, and I will kind of sponsor this space. And then there is a third, which is, let's say, the brown segments, where ultimately do you believe the risk is so high that you want to have a transitioning out plan from this, right? How do you convince risk? And therefore, I think to the point that Mr. Nair also said, and a lot of the colleagues said here, it has to flow from the top. Is there a core belief that this is a subject which indeed will play out its tentacles over a period of time? And I think some of the balancing act that we have to do is, I'll pick up a transition risk. Transition risk potentially could play out over the next 10, 15 years. Many a times, we are dealing with stakeholders who might have a 3 to 5 year view, right? And I think that is where you don't have to start migrating 100% of that outlook on your balance sheet in the next 3 to 5 years, but do you have a plan of transitioning out over the next 10, 15 years? I think that's what is important. You look at employees. Employees is an important stakeholder, right? Is there clarity flowing in from the top? Are there incentive structures aligned for employees? Is there a belief within the institution that makes even the RM then say, okay, look, I think this is the ethos of the institution, right. And therefore when I sit in front of the borrower, I'm actually also nudging the borrower to say that, can I, should I be migrating and having my own transition plan? So I think, I think everybody is aligned. It's just that people are at different places. As I said, there are times when we go through, I would say, tactical decisions, in terms of the rates that we have to offer. I think there are, there will be submissions we make to regulators, how they can simplify some of the, or help us create more flows through the green deposits or green bonds. But I think at a big picture, I think we are all aligned in this journey.
Super. And I think, we could go on and on, but I've got signals from the organizers. There are panelists waiting online. But before we close, I want each one of you to tell me the first word that comes to your mind when you think about blended finance in mobilizing resources. We'll start with Neha. Very quickly, if we can just have a rapid fire, one word mantra to the audience before we close. Blended finance in mobilizing resources.
Yes, I think simply, when you said that we need to amp up blended finance.
Ramp up, one word?
Yeah, amp up. It actually amp up. I really amp up. So it is no longer going to be the old, because actually it is very, very limited, especially in the Indian case.
Super.
So blended finance is not just finance. You need technical assistance, project advisory.
Technical assistance, let's keep it at that. Niranjan?
Belief and specialization. Thank you.
Rupa?
Scale.
Scale. Anand?
Must make money for the bank.
Lovely. So there you have it, all of it. Thank you very much, panelists. It has been amazing talking to you, and we hope to engage with them offline. Thanks again, everybody.
Also, may I request Sri Chopra to come forward to present a memento to the panelists and the moderator. Yeah, sure, ma'am. Sir, 1 minute for the photograph. Thank you, sir. Thank you, ma'am. Thank you.